Hey folks, David Frost, my strategic forecast. You're here for another episode of Common Sense Market Analysis. Today is Monday, August 7, 2017. We're looking at a daily chart of the SPY or Spider, which is the proxy for the S&P 500. And we had another extremely light volume day out here in the markets today. Just over 32 million shares traded in the Spider, and that's competing for the lightest volume day of the year. I'm not sure which one it was, but here's another one down here where the volume was, bear with me, 35 million shares. So, we have basically, if not the lightest volume day, we're close to it. And whatever happens in a light volume day is basically meaningless because there's no participation in the market. So there's no conviction one way or the other. And typically, as you know, in light volume markets, the path of least resistance is higher, and we saw that today. The spiders were up to 0.2% for the most part, 47 cents. So it was a little higher, but you're certainly not going to get any downside activity of any meaningful value in light volume markets, specifically this light. And that's just the way it is. We're in the summer doldrums. However, we're getting into that point. As each and every day we go forward, we get closer and closer and closer to the point in which I'm expecting a turn to occur. So we're in the zone. I would say that keep your eye out for late this week or into the first part of next week. And it could happen in any number of ways. And I'm just kind of giving you something to think about because eventually we're going to see it. It's just a matter of when and how it happens. It happens in a number of ways. So number one is it could happen with a blow-off top. And let's speak to that for a second because a blow-off top can mean different things to different people. As far as the market goes right now, I'm not expecting a blow-off top to be 100 points in the S&P. I'm not expecting 1,000 points from here in the Dow. It's just not in the cards as far as I can tell. So what I can see on the upside for the S&P and also translating over to the Spider is maybe 20 to 30 handles, $2 to $3 in the Spider from here. That's it. I don't see much more than that. It's a give or take, but that's really all I see on the upside. Let me explain a little bit farther why. So here you had an up move, and then we had a nice pullback. And this is the type of pullback that builds energy for another run higher. And what this pullback produced, if you take the level down here where we pulled back to, and you say it was around $240, right? And then you take where we stalled out on the upside right here, about 247. That's 7 points or 70 handles in the Spider. That's a nice run. I don't see that happening out of this drift sideways that we have in the summertime. I don't think out of this drift that we've got going on, I don't think we go 70 handles to the upside. Yes, it is a bullish pattern. There's no question about it. We're above the moving averages. It's a bullish chart pattern. There's no doubt about it. But I don't think we get 70 handles out of a pattern like this, especially in the summertime with light volume. Even on a blow-off top scenario, I think we get 20 or 30. I can't see any more upside than that. Anything of meaningful value, that is. Maybe it's, 30 to 40, but I see 20 to 30 points on the upside, $2 to $3 in the Spider. So back to what are we looking for in terms of a reversal? There's a lot of different things that could happen. We could have a blow-off top, and we could have a reversal the next day. We could have a blow-off top, and we could just drift lower, and then we end up just closing below a certain level one day. We have some news-related event that adds a spark to the market, and the market just decides to sell off, and all of a sudden we're down 1%, 1.5%. Next day we're down another 1%, and next scene shows we're down, 2, 3, 4%, and they start talking bearish, and that becomes a self-fulfilling prophecy. Next thing you know, we're down 6 or 7%, and you got a correction underway, and that's the way it works. The other thing that could happen is a gap and crap. We could go up to $250, give or take, in the Spider, $2,500 in the S&P 500, and that could happen, early in the morning. We could have some news overnight. Whatever happens, we could send the market higher. All of a sudden, you find the market's drifting lower, and by the close of the day, we have a reversal on our hands, and that promotes more selling, and then you just need some other kind of spark. They'll pick out some news event that's negative, and then next scene shows you have a correction occurring that way. It could happen any number of ways. You could put in a doji candle, and then a doji candle is my favorite because we have something to trade against. If the market put in a doji or a reversal candle, we have something to trade against. We would be trading against either the doji candle high or, in the case of a reversal candle, the prior day's high. You can short the market against that and any close above that on a daily chart, and you have to move out, but that's your benchmark. At least you have an area where you know where you're wrong. That's the whole idea of trading. Any pattern, any time frame, whether it's a 10-minute chart, a 5-minute chart, an hourly chart, daily, weekly, monthly, it doesn't matter. If you have an area where you know where you're wrong, it makes trading a little more comfortable for those that are uncomfortable entering positions. What makes people uncomfortable entering positions is they've been burned too many times. So each and every time they enter a position, they think they're going to be wrong, even though it looks right at the time. And that's what causes a level of discomfort. When you have something to trade against where you know where you're wrong, it becomes a mechanical process. And that's really the way the business of trading is. It's mainly mechanical. Obviously, there's a lot of art to it, and there's a lot of technical analysis, obviously, that I do. But in the end, when I enter a trade, it's very mechanical in nature. I'm entering a trade based on a pattern, based on a price, based on a time value. And where I know I'm wrong is where I exit the trade no matter what's happening. If the market closes above a certain level or below a certain level, I move out of the trade, and sometimes it bounces back and I feel like a fool, but you know what? I'm trading correctly, and I'm going to be right way more times than I'm going to be wrong, and that's just the way it is. So you have to treat the business of trading as a business, and it becomes a process and a mechanical process at that. All right, there's my soapbox for the day. We'll go over to the IWM, and what we see in the IWM is a much weaker index than the S&P, and herein lies the potential canary in the coal mine, or one of the potential canary in the coal mines. As you can see, this chart looks completely different than the spider. We've been selling off for almost 2 weeks, and now we're starting to go sideways. And when the market goes sideways, we have a down move, okay? And now the market's going sideways. So even if we rallied a little bit, let's say the spider went up $2 or $3, the S&P went up 20 or 30 handles, and the likelihood is that the IWM would go up, a couple of bucks, but that doesn't mean that we're going up here to the old highs, make new highs. We can still stay well inside of that, make a bearish wedge pattern, and then head lower after that. And that's the likely scenario just looking at the IWM from where we are. So I believe the IWM is a canary in the coal mine, along with the transports, which we'll get to in a minute. But as you can see, the chart now looks completely different. The spider's above all the moving averages. Now the IWM is below the 20 and the 50 period moving average. So they're completely different. The IWM is telling us something, and we have to be aware enough to know what certain markets are telling us with the probabilities in our favor, meaning, sure, the IWM could just turn around, rally, and make new highs, but that's not what the probabilities of this chart pattern is telling us. What this chart pattern is telling us is that the IWM sold off long before the spiders even considered selling off, and that should be a tip-off that there's something brewing under the market. Now, when you talk about the broader market, we know, and I've talked about it before, that the breadth of the market is not very strong. The Nasdaq's been going up on a very, very few, limited number of select stocks that have been driving the Nasdaq up. Same thing with the Dow. The Dow's been driven up on Boeing, McDonald's, Apple, and maybe one or two others, but that's about it. And so when you take that into consideration, that means that the breadth of the market is poor. That means we do not have wide participation on the upside of all the leading stocks or all the stocks within the indexes. And that's troubling, and that tells you that eventually we're going to get the turn that I'm expecting and have a correction in this market. It's just a matter of when and how it begins. One of the members mentioned to me that we have a doji candle in the IWM, and it's a good spot, and I get that, and that's fine. I like what you're looking at. We need to look for certain things that could be meaningful in the market. But what I do want to point out is that today was such a light volume day that you can't read into it. We have a very narrow ranging day, meaning from high to low. We're making a bearish pattern. What we like to see in doji candles is we like to see them occur at low points on charts, and it doesn't have to be an all-time low or an all-time high. It just has to be a recent lower high. Here would be different than it is where it is today. Here would be very different than where it is today. Here is different. Here is a doji candle, and that was meaningful. You see what happened? The market went down after that. So where we are now, I'm more looking at the potential for a bearish pattern developing or even a bear wedge pattern, which could send the market a little bit higher, down move, up a little higher, and then we have another down. And that's an ABC pattern or a zigzag pattern in the other direction versus the ones we've been looking at in crude oil or in the gold market, for example. Those are on the upside. Right now, we're looking at a potential, if we did get a wedge pattern, as an ABC corrective pattern on the downside. So you would have the A leg here, the B leg here, and the C leg down. But as far as this doji is concerned, while yes, it is a doji candle and they can be meaningful, but they're not usually meaningful in the middle of a range in no man's land. Right now, where we are is we're in a space where we're beginning to make a bearish pattern, and that's what has my eye more so than the doji candle. But I like what you're looking at, so keep working hard at it. I appreciate that. Looking over at the transports, it's really the same routine that we just discussed in the IWM. The transports sold off much, much more than even the IWM did. And look where the transports are in comparison to the Dow and comparison to the S&P 500. I know there's all kinds of stuff out there about non-confirmation or confirmation signals, the Dow theory and the transports and all that stuff. And that's fine. You can read up all you want on that stuff. I don't really pay too much attention to that. I just look at each individual chart, take it for what it's worth. And what I have here is I have a chart that's been selling off for quite a bit of time now. It sold off from the beginning in the middle of July, the 14th. And ironically enough, where was the beginning of my date when I thought the window would be open for the cycle top? That was the 13th of July. And this topped out on the 14th of July. You see how that works? That's very interesting. And I'm not saying that we could have seen that coming and been riding the transports down all this time. All I'm saying is I find it interesting, and it's part Monday morning quarterback stuff, but that's how we learn. And it's interesting that that was the day or the time frame, one day later, where the transports started selling off and haven't looked back since. We sold off, made a bearish pattern, huge down day. Now we're making another bearish pattern. And until and unless the transports can get above the moving averages, and this red candle high right here, okay, there's nothing doing. Then it's in a bearish formation, and the pressure would be to the downside. There's a lot of overhead resistance to the transportation average at those moving averages at this red candle high. So even if the market creeped higher in concert with potentially the S&P going up 20 or 30 handles, like we discussed before, that's fine. That would coincide with the transports running into the moving averages and potentially selling off from there. So you can see my thought process. You can see where I think the market is headed. You can think the picture. You can see the picture that I've got in my mind about what's developing, and hopefully you can sense that I think we're days away. I think we're a week away, less potentially a few days more than that, but that's what I'm thinking. So I want you to understand where my mind is, where my thought process is. And if the market, if meaning the spiders go up a couple of bucks, $3, and the S&P's up 20 or 30 handles, you're going to hear about raising price targets. The Dow is already at 22,000, which is an important milestone, a big fat round number. The S&P gets to 2,500, big fat round number. You're going to hear in the media higher price targets, everything's bullish, the market's going to keep going, second half of the year is going to rally, going to be better than the first half of the year. You'll hear all that stuff. And guess what? The more bullish they become, the better off it is for a turn coming to a theater near you. Heading over to the gold market, we didn't see much movement in the gold market today. It was a very narrow range day, meaning from high to low. Nothing really took place. No change from the other day. Although what would be meaningful, and we'll see where the official close of today is, what would be meaningful is that if we closed below the low of this green candle here, which is 1263 spot 20, we're at 1263 spot 30 right now, so we're right on top of it. Any close below that low, and the market's first going to trade into the moving averages, but that opens the door for some more downside in the gold market. So I'm watching that level very, very closely. Other than that, there's no change from Friday, so we can move it along. And we'll go over to silver, and as we can see in silver, it is still weaker than gold. We're below the moving average. We didn't get back above the 20 moving average today. We closed down there on Friday. We're below there today. This generally will spell more downside coming. We were a stone's throw away from a 50% retrace today from pivot low to pivot high. The 50% retrace was right below today's low, I think just by a couple of pennies. And so it's interesting we bounced off that level. Now, if we came back into that level tomorrow, the odds favor we trade through it because we came close and bounced today. If we came into that level today, from an intraday perspective, that would have been a viable intraday trade, just for a scalp trade, an intraday trade. But the fact that we came close and bounced higher means that that level at the 50% retracement is not as important as it was today if we were to come into that level today. So what I'm trying to say is when you come close and it trades away, it lessens the importance of that level, in addition to the fact that we never want sloppy seconds. So if the market hit that level today or came up short and it comes back tomorrow, I consider that the second time around, and we don't want it the second time around. That can be applied to daily charts, hourly charts, weekly charts. It doesn't matter. It's all the same, intraday charts. And so it's all the same. Therefore, what I'm trying to do is just give you a little bit of lesson on what we want and what we don't want from either a swing trading or intraday trading perspective. You know, when the market's very quiet and we don't have a ton to talk about, I try and give you something of value. I don't want to waste anyone's time, and I don't want to just say I'm not making a video because nothing happened today. So I use this time in order to teach what I think is something valuable. And whether I've said it 100 times before, somebody can always pick something up from one of these lessons, and I try to give at least 2, 3, 4 of these little type of lessons on a day when it's very, very quiet so that we make the video meaningful and have some value. Going over to crude, it's an interesting chart. It's a little bit challenging. Let me explain why it's challenging to read this chart. So on one hand, I could say we have an up pattern and we're going sideways, right? An up move and we're going sideways, building energy for another move higher. I can do that from any number of places. I can do it also from here. We have an up move. We're going sideways, pulling back a little bit, building energy for another move higher. That's certainly possible. But I can also do this on a micro scale, on a short-term basis. I could say this was a down move, and this is a bearish pattern, setting up for another down move down to 48, maybe the 20-period moving average down here at 47.75, in that neighborhood. So that's certainly possible, and that would complete somewhat of a symmetrical move from high bearish pattern down to low. So from my standpoint, there's really almost no way to trade crude oil from here because both things apply. Both patterns are viable. The short-term pattern's viable, and even if we came down to 48, 47, 75, that still doesn't take the bullish pattern off the table. In addition to, we're in the middle of a range. Where do you want to pick the range from? Pick it from here to here, high to low, or even here to here, or from this high. So we have 3 potential highs and a low, and we're in the middle of a range any way you want to look at it. So there's very, very low probability that will be right in any trade. Obviously, it's a coin flip. I got a 50-50 shot being right. But those are not the kind of odds that I'm interested in. I'm not interested in a 50-50 shot. I need something more than that in order to affect a trade. So with that, we're going to watch crude oil to see which pattern develops. There could be a trade if we did come down into the 20-period moving average and complete this on a short-term basis, this short-term bearish pattern. That could produce something interesting depending on how it came there and what it did when it got there and what type of pattern it put in, or a reversal candle potentially. But right now, we're just going to watch it. There's really nothing to do. There's no high probability setup here. Now, before we move on to the next market, I'll point out that the hourly chart is interesting because after the low today, we went up and we got above the moving averages on an hourly chart and started to go sideways. So we've really been going sideways for about 3 hours according to this chart. And the more we go sideways, the more likely we are for higher prices on any chart, but in this case, crude oil. So I find it interesting that on the hourly chart, it looks somewhat bullish and it looks like the market, or the crude oil market, wants to trade higher. But where's the overhead resistance? Well, it's right up here. So our overhead resistance is only 30-40 cents higher. So again, not much we can do with a chart that looks like that. So therefore, let's go back to the daily chart and let's move it on to the bond market. Our favorite trend line in the bond market held. We pointed this out for a long, long time. So it held on Thursday. It held on Friday. The market backed off. Now we're hovering on the 50-period moving average. I think this is bearish. I'm looking at this chart from basically one standpoint. I'm looking at it from this down move, this sideways consolidation or sideways bearish wedge pattern, and my expectation is this promotes another move down. Until and unless we can get above this trend line, in fact, we need to really get above, well, now that high is below. See, the trend line creeps up each and every day that goes on because it's an upsloping trend line. So what I'll say is until and unless we can get above, close above that trend line on a daily chart and confirm above, meaning we really have to be 2 days above that trend line and the second day preferably above the prior day's high. Until something like that happens, this is a bearish chart that's going to likely promote lower prices in the bond market. What's interesting about that is, generally speaking, more often than not in history, right? In recent history, last decade or 2 decades, when you have a sell-off in the stock market, you generally have a rally in the bond market pushing yields lower. Money tends to flow into safety, and money will tend to flow into the treasury market when the stock market is selling off. What would be interesting is if we actually got a sell-off, and it's happened before plenty of times, but it's not pretty when we get a sell-off in the stock market and you get a sell-off in the bond market. There's nowhere to hide, and investors and others tend to panic in those scenarios because they don't know what to do with their money, and they tend to move to cash, not necessarily treasuries, but liquid cash, because there's nowhere to hide, and or potentially into the gold market. And that would potentially support the case of a run up to 1300, where, and I didn't say it tonight, but I'll say it now, the 1300, 1307 in that neighborhood, to me, is a stone cold shorting territory for the gold market. So I see lower prices coming in the bond market. This pattern stays hold that we've been discussing for quite some time. No change there. When you go over to the dollar, we had that nice reversal in the dollar on Friday, and it was a big up day, and today was a nothing burger day. Very narrow range from high to low. The dollar didn't do anything. So what I'm looking at here is the potential for, but it's too early to tell, for the dollar just to put in a few sideways days, build some energy, and make the next run higher. Maybe since it's consolidating potentially right beneath the 20-period moving average, maybe it builds energy for 4, 5, 6, 7 days, something like that. Builds energy and busts through it and trades up to the 50 period would be an interesting level. This would be a lot of overhead resistance. That's your next real major resistance point for the dollar. And we'll see what happens with the pattern over the next few days. It's too early to tell, way too early to tell, but it was a nice reversal day on Friday. And with that, I'm going to leave it there. I'm David Frost, my strategic forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.